Hello and welcome back to the ROI channel. This is a macro view and portfolio positioning, and I will be updating you all. I have re-entered the Transocean trade. So it's been a big winner for me in the past. Let's have a look and see. Hopefully that continues. Disclaimer, nothing I say is advice, of course, guys. It's just me putting my thoughts out there to the world, sharing what I am doing. For God's sake, don't listen to me or, or follow what I do necessarily. You need to do your own due diligence. And that is it. Apologies for my absence. I've been doing a lot of work in consulting with Singapore-based hedge funds. And I'm also moving house and I'm going to back to South America. So there's a lot going on. However, quick reminder, this is the big picture. This is the big picture over the next, oh, I don't know, decade, maybe longer, decade and a half. We'll see. And what we need to recognize is that we've gone up and we've had a pullback. And when it comes to inflation, when it comes to markets in general, nothing is ever linear. Even if it appears to be stable and linear, we live in a world of non-linearity and constant flux. So I am certainly anticipating, and we've seen recently with the recent CPI prints, an increase in inflation. And so the question is always, how do I protect my purchasing power? How do I potentially profit from that? By what will be inflated, i.e., real goods, particularly around energy, particularly again around oil, as you've seen with our friend Josh Young showing that in this particular episode of stagflation over the 70s, oil outperformed and oil equities also outperformed. Whereas if you look at gold, gold did very well and gold royalties did very well, but the producers actually didn't do much better, marginally at best, than the metal itself. So it took on a lot of extra risk without a lot of extra reward. So that's why I keep harping on about oil. So let's take a quick recap over the last 5 years. Uranium has gone through the roof. So there's one for the energy. The yield on the 10-year in the US has gone up 62%. So bonds have been smacked down for the yield to go up. Gold and silver up 50%, even though people keep complaining. I don't know why. Oil up 40% only. From a very low base. And the interesting one for me has been palladium. Palladium has been absolutely destroyed. I did call for a reversion between platinum and palladium because the two are basically interchangeable, and platinum I thought was far too cheap. Um, I think we're starting to feel the effects of the Russia and South Africa effect when it comes to platinum and palladium. So hence why I've entered a position into Sibanye Stillwater as a play on platinum and palladium and uranium. Apparently, those guys have some uranium offcuts. So here's where we're at. I expect uranium will continue to do well, but obviously it's run and we're at an incentive price. So who knows that will there be a further squeeze? Quite possibly, but we need to play the odds here. And what I'm looking for are things that people are hating on that have forgotten, and that still continues to be oil, coal, and now palladium, which I'm wanting to do a deeper dive into palladium. Just a point of interest in terms of the weighting. It is on the right here, you'll see mine. There's a comparison with Barry Rosen's weighting on the left. They are energy heavy also, but they do tend to delve a little further into the ag and metals side of things. I want to buy metals. I just need to be able to justify the juxtaposition between metals and more different types of energy. I essentially am buying metals, buying the steel offshore, floating steel in the offshore space. So as it currently stands, and this is not a recommendation, most people consider this crazy. I don't have a benchmark against which I have to perform. I don't have anyone to whom I need to answer other than myself. And so I just keep picking what I think are the best opportunities. Ideally, yes, I find them in different sectors so that they have some diversification in the portfolio, but it doesn't always work that way. And so I am very heavily allocated, at least in the Toro portfolio that's available publicly, to energy, 45% of which is energy. Broken down a little further, you've got EMPs, so explorers and producers. And then, of course, offshore is coming in at nearly a fifth of the entire portfolio. I do have 18% of the portfolio in cash that hasn't been reflected in here, but I am looking to add to some of these opportunities. And what I'm hoping for is that uranium trade will play out and I'll be able to rotate some of that capital into offshore or some of the metals, and then rotate that into the dividend payers, being coal. Coal's taken a recent pullback, so now I'm looking to enter in a little bit, um, particularly the likes of Peabody, Whitehaven, and Arch Resources. You'll see in the portfolio I've taken very small, tiny positions. They're only starter positions. It's very easy to get caught up in the day to day with all the different nonsense and media and commentary. So I always come back to Stanley Druckenmiller's idea of what's my job? My job's to look 18 months out into the future. So, 1.5 to 2 years out. What do I see as the best opportunity for that? Set it up and then wait. And the fund manager for whom I'm consulting, he has a hurdle rate of a 15% IRR, or in other words, he wants to be able to double his money in 5 years. Okay, so most people want to double their money every year. It's insane, some of the expectations. So, with that in mind, I generally look for a 20% IRR, but we're going to come back to this idea when I juxtapose uranium in the offshore space. So uranium has run, and ideally it runs, then oil goes, and then I roll it all into coal. But hey, I don't get to vote on that. Offshore, I still think has the greatest asymmetry to the upside. There are good dividend pays in the coal space and exploration and producers. A few multi-baggers still with 100% to run, such as Stoneco in emerging market financials. And I also think that the Geo Group can do another 100% from here. So my question is, what is really going to multiply? What could I reasonably expect to multiply over a 3 to 5 year time frame? And as I've mentioned in the Valaris video, 2025, midway through 2025 is where the bulk of their fleet has their contracts ready to roll over and they will be renegotiated up. We will really start to see a scramble for supply. So I'm playing for 2 years probably from then because I'm always early. Everyone, or the market takes a bit longer to figure that out. This is what's going to happen in 2025. We know that from Valaris's presentation. Let's say 2 to 3, maybe even 5 years from there. Let's say midway through 2027. That's what I'm playing for. What do I think can multiply in value from there? And I think it's these guys. I think it's the drill ships and offshore services equipment that's trading for 10, 20 cents on the dollar that has the liquidity runway to get to this event where we're going to have an inflection point and they're going to, in the case of Transocean, delever, and in the case of the others, maybe lever up to be trading on multiples of their cash flows, if not at least one times their book or replacement rate. So for me, Valaris is the biggest position at the moment. Diamond, I'm looking to bring down a little to maybe 2.5 or maybe even less than that. And Transocean coming up to 5%. Bore's not available in eToro, but I do have Bore in my private portfolio and I trade options on Bore as well. So you can join the Substack if you want to get my view on that particular company. I'm a massive fan. I said to myself at the start of this year, I wanted to be more disciplined and better at scaling into positions using some technicals. So here's the way that I should always do it. I don't always do it. I get a bit excited, like when I front end loaded on Valaris. But anyway, the point is 3 to 5 tranches of my 1% weighting to get to a 3 to 5% position overall. That's a pretty basic plan. I don't think I really need to go any more in depth there. I'm looking to buy the bottom of the RSI if I can, and then either hit the bid or short put options. If it's just hanging around in a range and I want to buy it, but I'd like to get it even cheaper, that's where that comes in. And if you're a member of the Maverick Life, you'll learn all about how I do that. So here's an example. Here's the chart of Transocean recently, and here you can see we've had a lot of volatility, the ups and the downs when I start trading. Then I exited because I had questions around maintenance. I no longer have questions around dilution and issuance because they've been answered by my good friend Tommy Deepwater. And here we find ourselves back almost at the original entry price, a little over the original entry price. So here I'm looking down at the RSI. It means momentum is really bottomed out, and I think now's the time to start allocating. So I will be allocating even more heavily over the next week. Again, This is just a basic technical and charts. It's nothing magic. And the key factor is I have a fundamental thesis upon which I have conviction. Okay. So it's no good buying the bottom of the RSI if you're buying something that's really overvalued and it's going to be a disaster. Here's a reminder on the thesis. So rig is a pure leverage to rising day rates in the drill ships. Okay. It has a ton of debt. If it doesn't get to 450, maybe even $500,000 a day rates, I don't think the company's going to survive. It's just got that much debt on it. However, were that to happen, we come back to my original thesis from 2021, which would be you enter a bankruptcy, a restructure, the lien holders get paid out, and you still have equipment value that would allow shareholders potentially to realize some kind of recoup on their cost. Why will day rates get to 635 a day? Because that's what's really needed to provide that 15% IRR hurdle rate for new builds to come online. So these companies, as because there's no competition left in town, and we need the oil, they're going to command higher and higher day rates. In the case of Transocean, they're going to delever. They may even start buying back their own stock until it makes sense for them to order more drill ships. And that isn't going to happen until $635,000 a day to get a 15% IRR on building a new drill ship at 1.1, 1.2 billion. That's my plan. First exit tranche. Let's say this actually does happen, and I'm right. One times PB, one times price to book value is around $13. That just means the book value is at $13. We're trading at about a third of that. I'm anticipating the market will come up to roughly book value. If that happens in 3.5 years, is that an acceptable rate of return for me to wait? And I believe that it is. If it takes 3.5 years for me to enter at 480 and exit at 13, let's say, that's a 32% IRR. I will hold a few tranches both as arrows in the quiver to continue in the event of a blow off top because I think the thing could honestly trade around $20. I will start to sell a little bit more if we enter crazy mode and a little bit more up to around the $20. If we get there, I would expect to be fully exited the position. Here's just a thought experiment. That's all it is. Coming back to my original idea about what would it cost to replicate this company. And remember, Transocean, as Tommy always talks about, has specs on their rigs that the others don't. So that's an advantage for them. To rebuild this fleet, this company of 39 floaters at, let's just call it 1 billion flat, you would need, and then you divide it by the shares on issue, it suggests that the replacement value is around about $48 per share. So it's trading at about 10 cents on its replacement value. I am not suggesting the company's going to get to $48 a share. Okay. I am simply saying this is a very wide margin of safety. That yes, the company does have a lot of balance sheet risk. I'm just interested in this asymmetric risk return, given what I believe and the conviction that I've formed about the entire sector. Okay, so you can't really see it here, unfortunately, because it was a bad chart. But that was just showing that the median value over the longer term cycle has been around about 1 times book value. Thank you very much for watching, guys. Take care, do your own due diligence, and I look forward to catching up with you in another video shortly.